Hello, everybody. My name is Jeremy Francesi, and you are listening to First Floor Conversations, where the view at the top is only as good as the foundation which preserves it. Today in episode 65, we are joined by Mehdi Tabdili. Mehdi's the co-founder and chief investment officer for R2 Advisors, a Washington, D.C.-based consulting firm that specializes in helping organizations turn their accounting, tax, and investment functions into a competitive advantage. Before starting R2, Mehdi earned a bachelor's in computer science, a master's in quantitative finance, which jump-started his career working for companies like Capital One, Fannie Mae, Freddie Mac, and most recently the World Bank investment management team, where he was relied upon for investment advisory, risk management, and investments as a whole. Today, folks, we're talking investments, we're talking finance, we're talking business. Let's buckle up. Mehdi, welcome to the show.
Thank you so much. It's good to be here.
I'm very excited for the conversation. Everybody listening, if you're tuning in, watching, hello. If you're tuning in, listening, just want to say thank you to everybody that's been tuning in. The financial conversations have frequently dictated a really nice response. I think that we've proven over the last 65 episodes that folks are interested in what takes them forward in their career and life, and obviously money matters. Mm-hmm. And so I was very excited to have Mehdi on and to talk. You've had an incredible background. And so for those listening, we'll spend a little bit of time on the front end. We'll talk a little background so you can gain some understanding in really what you've done, which is more than I think most investment advisory firms have done. And so before we get into all the nooks and crannies of money and markets, let's talk on the basics. Give us up to speed on like where's home, where are you from, those basics, and then we'll kick it into the business stuff after.
Sounds good. So I'm actually Iranian originally. I grew up in Turkey, Dubai, Spain. Moved to New York when I was in high school. My background as how I got interested in this field is my grandparents from both sides. They were in the market from like back home. So I was always had this interest of how stuff gets bought, sold, how people think about it in a very basic, classic way. So that's why I was always interested. So when I came here, I always had that in back mind. I was always following markets, and I came here for education, and then I went up in university and I stayed and I started working here.
So when you say that your family was in the markets,
mm-hmm.
So it's funny, money is a conversation, even if you're not in the scope of investing, like mm-hmm. people that are listening to me on this podcast know that I talk about money. Mm-hmm. It's not about how wealthy we are, although that matters. It's more so it's a resource that's on this planet that drives a lot of the activity. It's a valuable commodity, right? And so with that being said, it's often coupled with religion and politics, and in many households, money isn't something that's talked about. If nothing else, sometimes it's almost discouraged to be talked about in the household. What was it like when you grew up? Was money a topic of conversation? Was it a part of the household, like childhood when you were growing up, like finance and being responsible? Was that part of the normal conversations? What was that like?
Well, growing up in Iran, right, because talking about money is very cultural, of course. I think in the US it's more conservative about talking about money. But if you're growing in a lot of other places like Middle East, Europe, people talk about money. Like asking somebody how much money they're making is not like a taboo questions to ask. But more important than that, in Iran, because we had so many like events, inflation, war, revolution, right? Taking care of the value of your money is so important. So, and this is like from your dad to your mom to your uncle. Everybody every day thinks about how to preserve the value of their money, what to buy so their purchasing power doesn't come down. It's not some abstract thing you read in like your college course or something like that. It's something you live in, because every year your purchasing power is coming down. So you need to be able to think of that, like what you have to do. You have to buy real estate, you buy like dollar currencies, gold, right? Gold is the biggest, and yes, the conversation was in the house because everybody talked about it, like they were worried about it. How do we preserve our money? How do we build wealth? What do we have to do for our children to be able to preserve our wealth, basically? And that conversations, I think, is important everywhere, really, in just a matter of how much impacts life. It's different from country to country and culture to culture.
Did you find that when the conversation and the approach to preserving wealth, which I think the word preservation is often not brought into the same frame as finance, right? Preservation is a very different mentality, because it sounds like, in the way I hear it, and again, for those that are listening, like, I'm taking notes. I do this to learn myself and understand what's happening and level up myself. But Preservation is an interesting way to approach it, right? It's if I have cash, is it a safer place, even if it's growing, to put it in real estate? It's. Did you find that the concept of preservation and wealth building, was it about growing and conquering, or was it more so a defense of safety and risk mitigation from just a lifestyle standpoint?
I think it's a combination of both, right? So I think when you have money, I think the first thing you do is all about allocation of it, right? So first thing you want to think about is you want to be able to preserve the biggest part of your capital, but at the same time, depending on if there's inflation, if there's other events going on, you want to be able to grow your money as well. So I think preservation and investments and finance, they're very the same kind of concepts. Because if you don't know your rate of returns, for example, the inflation rates, how do you know you're preserving your capital? So it's not really being defensive. It's more about growing and having because a lot of times, depending on the country you're living in, the culture, you think the money in the bank account is the safest place. But that's not the case, right? Because if you look at it in 10-year periods, 20-year periods, that's probably the worst place you could have put your cash in. And I think that's the kind of conversation you need to think about. Just having cash and sit on it, not the best idea, but you always need to have some kind of liquidity in event some event happens and you need it. So it's just a matter of how much of it.
Makes perfect sense. So I'd love to understand, so you grew up in an environment where your family was in the markets, right? So finance and asset allocation and preservation of wealth was a bit in the DNA and the fabrics of both communication as well as just daily workflow.
Right.
When you came to the States and you came for your bachelor's before going to London for your master's, what was top of mind? Like, did you know finance and investments and that world was ultimately what you were going to spend your time doing, or was there other curiosities?
I think there was definitely other curiosity. So when I talk about my family was in markets, it wasn't financial markets. It was more of so in like a lot of countries, you have actual markets when real goods gets bought and sold. Those are like a traditional markets that you had it here as well. Think about like the Chicago exchange, right? So in the classic, that's where they came. And so the point from that was you have to think about the supply, demand, right, for each products that you have. The same kind of where people think about if the price of something goes up and people just run after, they follow the price instead of thinking about is that the right thing to do, or something like the price plummets, right, in the real assets. So that was a kind of background, and it's almost like in your, you always think about it and you don't even think that's like other people don't think that way because you so grow up with it. But when I came here, I always had this, passion for technology and, at that time particularly. But when I went to university, I studied computer science. But when I came out of it, my first day of job, I was at Fannie Mae, and this was before the housing crisis. It was on the trading desk. When I walked into it, and I saw all the numbers and the energy in the room and people just like yelling and screaming and the numbers just going around, I just fell in love with it. I was like, I need to be part of this world. This is where I belong, and I want to, do whatever it takes. So that's why I got my CFA after that. I got my quantitative finance degree after that. So it was just a matter of realizing, that's where I wanted to be. The moment I walked in there, it was just something hits you at one point.
It makes a lot of sense, though. I can't say it's the same thing as when an athlete walks into a loud stadium of fans, but there's an element of competitiveness, of fast pace, the momentum of it. I can imagine walking in, being new and young, frankly, and you're walking in, you're like, this is a crazy world, But when that took place, right, at that point, you would just finish your undergrad, you're probably 20, 25 in that range, right, as a young professional, huge dreams and goals, but you're also in a position where you're starting to put together the pieces of what are you good at, what are you not good at, and how do you mend that so that you become more competitive as a person, right? I think, and one thing, shout out Magnus, who's doing all the production work today. So shout out that live studio, no Zoom, right? I think a lot about like the me economy, and I look at that in two fronts, right? From an economic standpoint on how much money am I putting out and how much am I bringing in. I think a lot of my friends are in so much debt because they're not thinking about things in a logic standpoint. Like you're not making enough and you're spending a lot. But the other side is from a skill set standpoint. Like what are you exporting and what are you importing, right? And from that standpoint, in that point in life, what were you thinking about as you move forward? Because what I know now is you got to a point with certain banks, whether it was Citibank, you were managing hundreds of millions of dollars of funds and making very big decisions for people and very large amounts of money. But at that point in time, right, it was maybe a new career and a new interest. How did you bridge the gap from new interest and excitement to executing on that goal and getting there?
So I think that at that moment I realized how much I cared about this is where I wanted to be, right? It was like, how do I get there, right? So I started talking with people that were in the position that I wanted to be, managing billions of dollars, right? And they told me the path you need to go is getting a CFA will get you there. And, you need to educate yourself, you need to think about it. So that's why I started, getting my CFA at that point. And that was my jumping bridge, really. So that from that part, I was able to get on a desk, start, managing, because, when you start managing money, they usually put you on like a money market desk, which is basically just, you do cash flow management. You put money in like a short-term instruments, like money market funds, treasury bills, stuff like that. And from there, you start moving up the ladder. You start trading bonds, mortgage-backed securities, other like corporate bonds. So, but it's step by step, right? So from moving from not managing anything, right, and then managing billions of dollars, it took a long time, lots of hard work, and a lot of studying as well. It wasn't just you walk in there and they're gonna give the key to the to the place you want to be.
One thing that I don't believe is talked about enough in the financial services market is mental health is not the right word, but we can just say it. It takes balls to manage $100 million of somebody else's money and wake up and know that you can manage your emotions. That's a lot of money. And I think that anytime I've met you, and though we're still developing the relationship, like you are cool, calm, collected. I think if you want somebody managing your money, that's critical, right? I think I had a boss that said this, so shout out JVD if you're listening. Everybody wants to be a lion, a tiger. They want a big roar. And there was always that approach that he and I talked about a lot, was like, I just want to be a duck. Put me in the craziest turmoil in water, and on the surface, you won't notice a thing's happening. Underwater, though, I'll be paddling like hell. And I think in finance, it can be very similar, where today we started talking and you're saying you're buying a lot today. 8 of the last 9 days in the market have been down. And I think a lot of people emotionally react to the market, but if somebody's managing your money, they got to be cool as a cucumber, because volatility is ultimately a perpetual game. It's never going to be a flat line. So do you feel that was something that was native to you? Like, how did you get to the point emotionally and from a confidence standpoint where the volatility didn't bother?
I'm so happy you asked that question, and it's such an important question to ask. So one of the main reasons I wanted to start my own firm, right? So when I worked in all these institutions, right, managing millions, billions of dollars. So then the question becomes in my mind, why individual investors, they lose so much money? They make the worst decisions at the worst time in the market. They sell lows, buy highs. So what is the difference? Because people make decisions emotionally. So what makes the difference for institutions is there's a process, right? So a lot of times you need to have a right process in place, right mathematical, quantitative process, that you don't make decisions based on your emotions. Because if you make investment decisions based on your emotions, one day you feel good, you buy a lot of stuff. One day you feel bad, you sell everything. If it's raining outside, you might do something. If it's sunny outside, you do something else. That's not what we do. So every investment decision I make is based on mathematical, quantitative process that we have internally, a lot of the research that we subscribe to, and none of the decisions that we make is based on my particular emotional feeling of if I feel good about something, I feel bad about something, nothing like that. So whenever I do something, it's nothing to do with my emotions. I can have a great day or bad day or whatever, just because the process says that's the time to asset allocate, to buy this, to sell this, and I just follow the process, and it has worked really well.
Do you have an example or a situation where For example, salespeople learn best when they lost the sale. In my opinion, like I vividly remember losing a $130,000 deal because I made some mistakes as a young professional, and listening to those, like y'all know, I'm perfectly imperfect, right? I lost a sale because I made mistakes, you know, and there's certain mistakes that I've never made since, you know, and it was in my world, like, you know, a COO saying that they make all the decisions and you lean into that person. They have no leverage in the company,
Right.
and you're pitching the gatekeeper,
Right.
and all they can do is say no. And all of a sudden you get to the proposal, they have no idea what's going on, and the deal is dead from the start. But for me, that was the learning experience of, okay, Jeremy, don't do that again. Ask the tough question, push through, or you're going to lose it anyway. Were there examples or experiences that you learned the hard way that have helped kind of callous that muscle, or has it been really sunshine and rainbows from the start?
No, I mean, there's a lot of, like in investment management, you learn something new every day, right? It's not something you don't, it's just a matter of, it's almost like when you are doing whatever, you have to go based on best odds that you have. When I talk about like, we make investment decision based on the process, that process gives me the best probability to have the highest return for that asset class. Does it work every time? No. It's like blackjack. You might dabble on, like when you have a 6 on your hand, and you might win. But did you win for the right reasons? No. So in investment decision, the same thing. We make decisions when we have the best odds, but just having the best odds doesn't mean you're going to win. It just means if I do this 100 times, I'm going to have more wins than losses. And the most important decisions you make, and the thing I have learned for the last 20 years, 15, 20 years, is you have to don't get emotional for a position. Like particular stock, particular company, they're not like my children, right? I cut them loose if they're not performing, and you have to be able to have this kind of flexibility to change your mind in a day, overnight, right? You shouldn't have emotionally just because you think you're right in something. There's no right or wrong. You are here to make money, and you have to follow that. There's no like personal connection to whatever position you have.
I like how you worded that. People do get emotional, and emotional to an extent where it's more ego-driven. Like I have friends that'll hang on to an investment they know is a dead investment, but it's a pride thing. Like it'll come around. It's like, even if it does, if you sold it at the loss and recouped the capital, could you allocate it elsewhere and get a return? You know, but I think there's a level of distinction that's required in this conversation in particular, Mehdi, because you're working with a caliber of investors that they have capital. They've done something right. Well, I think this is worth noting. There's in America, the average person doesn't have $1,000 in their bank account. The average income is $44,000 to $50,000 a year, and so there's a level of success that the people you're helping, they've done something right to accumulate some money. Right, and there's three steps that I've learned ultimately as a young professional and looking at, like, I value money. People know like you save to make a move, not just to save. Right. It's a resource, but you have to make it, you have to save it, and you have to multiply it. Most people struggle with the second, and very few people get to the third. When you're working with investors on that third, right, the evolution of fintech that has made B2C finance resources more accessible has never been more abundant, I'll say, right? Things like Acorns and Robinhood, it makes everybody feel like a hedge fund manager because they're 2 points up on a $50 portfolio. When you're working with new clients, right, as we shift from kind of background and we shift into the current state of affairs, when you're working with new clients and you are in the process of transitioning from not managing their money to managing their money, what are some of the conversations you're having with them when it comes to expectation setting and getting them familiarized with what's Mehdi and R2 Advisors' approach to investing money, which is obviously unique compared to the industry peers?
I'm happy you brought this up because that's, again, the conversation that why a lot of people don't have like enough cash in their hands, right? So one of the ideas, right, because working on a hedge fund before myself, you need to have a particular minimum to be able to invest in a hedge fund and their strategies, right? And to me, it was like, so basically, if you're rich, you get access to better, right? So I wanted to be able to give that kind of a strategy to the people that have less of money, right? They still have money, but not as much as you have. Like
you don't need $1 million to get in the door.
You don't need $1 million. But in the past, it was much harder to do that because of the technology for me to able to implement that kind of a strategy across many accounts, right? It would not be possible. But with the new technology that you mentioned yourself, now I can do it. So my vision is, right, a lot of this like a strategy that you see in a lot of different hedge funds to make it accessible to the people, to the businesses, right, that don't have that much of capital to go to a lot of bigger firms that they have higher requirements of the capital. And that was very important to me. And I think really resonates to our clients as well. I think from like when you talk to clients, it really depends. It's case by case basis, because everybody, each business, they have different like goals for themselves. Like like associations, the way they need to manage money versus a company that has a lot of excess cash. It's really different. So the first thing is understanding like their cash flows, their risk tolerance, how long they want to have the money, and right. So it's a lot of different conversation and needs to have depending on each case.
Understood. When you look at the clients you're working with, what types of clients are they? Like, are they commercial clients? And this is for me to understand a little bit more, right? What does the general spread look like? Is it really anybody and everybody, or do you find that you're working within a certain industry or niche?
I think being based in DC, right, we have a lot of our clients are government contractors. We have a lot of IT technology companies. We have basically companies that are mid-sized, right, and they're looking to have access to our investment management techniques and skills that for them, if they want to go to anybody else, would cost them so much more, and they wouldn't have access to the kind of expertise that we have. But it is a really wide range of clients we have. We have very wealthy individuals, healthcare companies, all that.
So if I'm understanding it correct, you have commercial clients that take profits and invest with you to grow the bottom line of the business, but you also have consumers, like for example me, that come to you with however much they've saved that's liquid, and you can invest it accordingly, correct?
Right. So we really have our business. We have two sides. We have the active investment management. So that's more geared towards individuals, right? Wealthy individuals. They want to have more advanced, portfolio management strategies. And we also have our advisory for like 401ks. So a lot of businesses, we are advisor on their plans. It's more like a passive investment. Even on our active management piece, we have firms that they have like extra cash flows on like month-to-month, quarterly extra, and they want to be able to invest it for like 4 months, 6 months, a year, right, and have some kind of return. And then that again depends on the companies, because each company's cash flow needs, how the revenue comes in, expenses goes out is different. Well, becoming a strategy to maximize the return for them, so the money is not just sitting in the bank account.
Understood. For those that and I think to maybe. For those that may or may not know, so like for example, like ADP pays a gazillion people, right? And so how they make the majority of their money is not through processing fees. They take the trillions of dollars, the billions of dollars in taxes that they deposited at the end of the quarter, and they invest it on that float for 90 days. Right. They make a killing on it, and then they deposit your taxes, having made money off it. So just for those that needed an example of like, this is when Mehdi's talking about maximizing the return on investment, but like with respect to your cash flow situation, that's kind of an example. But I want to take a step back and for those that don't know, and I don't think a lot of people do, the difference between passive and active management. Can you shine some light on what they are and how they differ?
Sure. So I think the easiest one to explain is active management, right? So active management, basically, you would have a portfolio management that would actively select particular ETFs, exchange of funds, particular stocks, bonds, and they would actively, on a daily, quarterly basis, they would buy, sell particular positions. The passive strategy, basically, you don't do that, right? So you just basically say, I want to have 40% stocks, 60% bonds, and then you're not going to touch it for 1 year, 2 years, or 5 years. So for last, I would say 15 years, right, there has been, until last year and this year, there has been the move in the market has been from active to passive, just because the market has keep going up. But this year, if you have done passive management, you would have not done well. The active managers are way outperforming your passive manager. So, and the important point here is your active manager, right? If they have the right strategy and they pick up the right position, like rocket stocks versus the better performing ones versus the worst performing ones, they can generate way more versus your passive ones. But when the market is just, you're in a bull market, everything keeps going up, passive one's probably a better strategy. So it really depends on the volatility. If a high volatility market, the active manager would outperform the passive ones. So that's basically the main difference.
Makes sense, and it makes sense why you guys are able to you guys do both technically.
We do both, yes.
Right, it makes sense. And you guys have I like your guys' approach, right? So I think a lot of folks in the financial and investment advisory space say this is what we do, this is how we do it, take it or leave it. But I like that your approach is more so tell me what your goals are with your finances, whether you're corporate, a commercial client or a retail client, I guess if you want to call it that. And based on the goals, you look at what you can offer and you put together a relationship that is beneficial. But I really like the structure you guys have in place. Because it allows people to be comfortable, right? And not and if they're conservative in their investments and they don't like risk, they're not exposed.
Right.
Because everybody's threshold's different.
Right. And one more point that I would add is it doesn't have to be one or another, right? So for example, I told this to most of our clients. So you can have big chunk of your money in passive management, but you want to have exposure, some percent of your, depending on risk tolerance, to active management, because that's where you really are going to outperform market and generate high returns, right? So you want to have some part of your capital in active management strategies, either as an income generation, right, or as hedges. So I think, and that's important because not all the active strategies are the same. So let's say you have $1 million in markets, right? But you're worried about and you're long only, and so you want to have some strategy that if market tank, you make 100 times that, right? So what would we do? We can make a strategy just for that. So it doesn't have to be just one strategy. It can be a different strategy depending on your needs, and that's what you need because you want to have something that when market goes down or up, right, you have a strategy that works out for you.
Right, it's flexible.
Yes.
And and I think that's a huge piece. Flexibility matters. Mm-hmm. But so does understanding that, and one thing I really appreciated when we first met and you, me, and Robbie got together was talking about the fact that history repeats itself, and oftentimes lack of depth of vision can be a detriment in managing finances. Mm-hmm. Because it's the same thing from the mortgage crisis, right? What goes up is going to consistently go up forever, and mm-hmm. ultimately it's not necessarily the case. There's mm-hmm. human error and there's incidences that take place, but it goes back to ultimately my philosophy, which is a little morbid, a little bit, but the truth is, like, if there's no business in history that's ever been around forever, mm-hmm. there's the way we do commerce, mm-hmm. but there's never been a company that's incorporated that's been around for hundreds of years. Mm-hmm. Every business eventually goes out of business. Right. It's about how much impact and how much is accomplished in the life of the business before its next journey, right? Maybe it's a Sears type situation where it's repackaged and sold. But my point being, there are predictable trends based on what is happening in the world around us. And one of the challenges comes from trying to manage your own money, or candidly picking somebody to manage money for you, is their ability to gather information, infer, and then use that intelligence to guide decision making. There's a difference between being aware of things and having actionable insights that drive decision making. And I think you've done a nice job of just understanding what's happening globally to understand really, like, yeah, the dominoes here may not be moving, but that certainly doesn't mean another domino has already been tipped.
Right. I think there's so many points to that, right? So first of all, when you are looking at the markets, right? Let's say you're looking at U.S. equity markets. It doesn't move by itself, right? So you need to have a bigger global view. I think my background, because I worked in World Bank, for example, that we trade in a lot of different currencies, different markets, and fixed income experience, like looking at how the rates moves, right? So you cannot just look at one market and decide, hey, this is how we're going to move. For example, like S&P was up like 10% going into August, but in a dollar basis, it was only up 1%, meaning it was just dollar getting devalued, and you think, oh yeah, the market was going up. But if you think about it, your purchasing power was coming down as well. So when you're looking at it, right, you need to look at the cross assets, right, and the volatility of how each asset is moving, and they have signals in them. So markets don't move by itself. Capital goes from market to market, from currency to bonds to stocks. They're all connected, right, especially now. And it's important because a lot of times when you talk to your financial advisors, they have no idea, right? They just look at your Dow Jones in points, right? And they say, hey, it's a good idea to buy something or not. But I think we wanted to, and again, when you work in an institution, right, that's kind of stuff they do. And we wanted to have that kind of services and that kind of knowledge, right, to our clients, because those clients wouldn't have access to it. And we are able to do it now, right, again, because of technology, we are able to. So we try to basically have institutional knowledge for retail clients that wouldn't have access to it before.
Is there anything that's got your attention from a global market standpoint today?
I mean, there's a lot of interesting things going on right now. I think one of the big changes that you see happening. So what was in the past, you could say, all right, my allocation, well, I want 60% equity, 40% bond. That was such a widely known, any financial advisor probably told you some combination of that. But the rate's so low, right? So if you allocate that much to your bonds, you're almost like, how much can it go lower? So we are seeing the big changes now. Instead of having that big of an allocation to bonds, you almost need the allocation for some kind of tail risk events, like having some kind of allocation to asset classes that if the market comes down, equity market comes down, they will do better, like having put options, put spreads, a lot of other options that you can do. So we are seeing in the market, right, in institutional space, that's where it's happening. But the retail investors is still stuck in having your 60 to 40 portfolios. And I can guarantee you, if the crisis comes and you have a market correction again, those portfolios are not going to perform as well. Just because you have this kind of allocation, how much bonds rates are going to go lower versus how much equity prices can go down. The main reason that that's happening is because the Federal Reserve, right, is artificially keeping the rates so low. The equity market has gone up, right? So you're in a space, you have to know where you are at that time and space matters. And when you're in this kind of environment, that if you have that kind of allocation, any sort of like 10 to 20% correction that is historically happens time to time is not like something crazy, but your portfolio is going to get absolutely crushed because your bonds part of it not going to protect you like it did 5-10 years ago. And that's a very important point to think about when you are talking to your advisor, looking at your account, on your retirement, all that. And one more point that I want to mention as well is when you talk to a lot of like your advisor, right, financial advisor, they always tell you buy and hold. Eventually it goes up. But I think the important thing, as you mentioned, a lot of businesses go out of business. The price you buy and hold matters. It's not like you can buy at any price and hold and it works. If it only works if you buy low and sell high, right? And if you don't do that, you're not going to make any money. So that thing is being sold to a lot of people, but is not complete truth. I think just a marketing strategy.
Of course. I mean, you're buying a small, tiny piece of a company. If that
Right.
company is no longer viable, progressing, investing in innovation, being a market leader, being valuable in the world of business, then your piece of that company is no longer valuable.
Right. And then a lot of structural changes happening, right? Especially with COVID this year. So you have these changes that were happening, probably would have taken 10 years. It has kind of like is happening in a year, in 2 years. So you have these companies that are, the business is booming, because of what is happening, and other companies that are basically suffering. But the question is, right now, is it time to do the reverse trade or not, right? So there's a lot of strategies that you can play. I think this year has been an amazing year for stock pickers, because you have these companies that are way outperforming market, and you have these other companies that are well underperforming the market. So, and then lots of volatility. So the volatility that is in the market, if you look at, we were almost all-time high, right? But the all-time high that we were in February, the volatility was half of what we're seeing now. So, I mean, that's one thing to keep in mind, and that matters.
Absolutely. And it's hard to keep track of all that if you are, and I think this is one thing to harp on, and whether it's calling Mehdi or it's just in general, if you look at the things that are really important in a day-to-day basis, most people will start off and say family, then work and career and goals, health, fitness, and money ends up being on that list. But it's astounding to me that we operate in this ecosystem where so many people will list those as priorities, yet they have a personal trainer for health, they have an accountant for their tax return, they have a lawyer for legal, and they don't have somebody that's managing their finances. You need professionals to help you manage the vital things in your life, because what they do full time is manage that thing that you can only do part-time.
Right.
But because acquiring information, reading and being aware of those things, it's not a casual job. It takes time, and it also takes work. It's a muscle. And I think that's something that a lot of folks don't necessarily wrap their head around, is gathering information and inferring it in a way where you can do those things and understand 60-40 is not going to work. The US market is just one string, like a big puppet show, where it's pulled to the right, but that's because the Europe market opening this morning is causing the open in the US to change how it's operating, right? It's all one big, a pulley system?
Right.
You know? I'm curious if there's any industries that have caught your attention that, and again, we're not giving investment advisory advice, right? Mm-hmm. But speaking freely, tech is so hot right now. Fintech is so hot right now. I'd even venture to say biotech is pretty interesting. And there's a lot of different markets but let me rephrase that are exiting their time of receiving a ridiculous amount of venture capital and funding that's inflated that market to a point where everything's worth everything. What are you monitoring when it comes to markets you're curious about that maybe aren't at maturity where you're putting money there, but you're monitoring them and it's a little interesting?
I think the most interesting market that you have to think about now, right, with everything going on. Let me just say something that you said, right? The value over is inflated, right? I think the value inflation, like you would in this market, in generally, valuation investing is dead. We cannot buy anything based on valuation, right? So that was probably in like 70s, 80s, right? You could done it. But the way that the modern investing has gone, right, is a lot of factor investing is based on the like economic factors, the different factor particular to companies like high growth, high debt, high beta, high dividends, right? And money gets allocated that way. So you can have some kind of secret information about a company, right, on the valuation side, and it still wouldn't matter because the way money gets allocated in a highest level, right, is based on particular factors now. So if the company is expensive and market's putting a value on it, it's like a nice house in downtown is more expensive than a house in suburbs for a square feet. Why? Because that probably has more growth, right? There's a value association. It's the same thing with stock. You cannot say it's more expensive or not. You're going to get absolutely crushed investing that way. One area that is interesting, right? So our view right now is inflation is picking up. I think a lot of people have that kind of inflation too. But if you look at a lot of industry, like natural gas, right? That is very interesting. There are companies that, and is already picking up, all right? I think natural gas has been up like 10, 15% last month, and I think that trend is going to continue. But the most interesting part is oil, right? So oil is the commodity that's back. So if you look at a big oil company like Exxon, a lot of those oil companies, they're almost in all-time lows, right? They're really down there and have high dividends, right? They have been horrible investments this year. But I think if you want to put a trade on, at this point, maybe too early, maybe you would lose some more money here. But I think if you look at a year or two, it might not be the worst place you can look at. But the way we do it, right, we always have pair trade. You cannot just go, we are long short a lot of times, right? So we have names that we like even in the oil sector and for long and short. So that's how we generate alpha, right?
What is alpha? Not to interrupt because you're on a roll. For those that don't know, what does alpha mean?
Alpha means basically how much you're outperforming market. Because if I just buy market indices, right? So that way market goes up, I go up, market goes down, then what am I doing? Really, what value I'm providing? For any advisor you have, right? If your performance is market below, then you could have done it. You could have just bought an ETF of any market and you have done whatever he's doing without paying any fees. So the value becomes when you outperforming market in a down and up days, right? And I think that's the very key point. A lot of people don't think about it.
Why do you pay attention to alpha so much? Is it wiring from big business where you're managing $1 billion, or is it because of how you are structured to generate? Is it structured because that's how you guys make money relative to your clients' return on investment? Like, why is that figure so important to you guys?
The figure is important because when you are comparing yourself to other firms, right? You want to be able to say, hey, there's two measures important. One is alpha, and one is a Sharpe ratio. It's basically how much risk you're taking for your return, right? And there are more technical terms you can use, but that's so important because you said your friend on Robinhood generated this much income. Yeah, but how much more risk he has taken to like the return we have? The risk is probably 10 times, but his return is probably 2 times. Is that good enough? I would say no, right? So I think it's important that you would need to quantify for whatever return you're generating, how much risk you're taking. So a lot of people, when the market goes up, they make lots of return, but the risk they're taking, right, is way out there. And this is like, you need to be able to quantify, because for any return, how much risk you're taking is important. And then how much alpha, how much you're outperforming market with how much risk you're taking. Those are the stuff that we look, because you want to able, when you go to the more sophisticated investors, you need to be able to show that, right? For a lot of retail investors, that's not the case, but a lot of times you go to in front of like a lot of institutions, you need to be able to quantify that, because a high return in a good year means you've been lucky with higher returns, and we don't want to be lucky, we want to be good.
Absolutely. Luck is not a strategy,
Yeah.
and I'm a firm believer of it's not what works, it's what duplicates.
Right.
Back to the investment strategy, it's not about how you feel about an investment,
Mm-hmm.
it's the processes, procedures, and resources you're using that make a quantitative decision, or a data-driven decision, rather,
Right.
to justify the buy or sell.
Right.
I want to talk a little bit, as we look at time, I want to talk a little bit about the election cycle.
Mm-hmm.
The market volatility is obviously a factor, but investing requires a level of discipline where even if you're a day trader, there's a little bit depth of vision, right?
Mm-hmm.
Even if you're a day trader and you're moving around money every day 100 times, there's still a level of what's it going to look like in a couple weeks, couple months, like you're thinking a bit. And in your case in particular, it's always about focusing on where's the puck sliding to and how can you meet it there, as opposed to, where are you right now?
Right.
What is going through your mind and the firm as a collective as you approach maybe rebuilding models and preparing for the election cycle, and what should people do and what should they expect from their advisor, maybe if they're working with somebody else?
So it's interesting, right? So the whole point I was talking about the processes, so I would take any sort of storytelling, any sort of narratives out of the investment decisions. What do I mean with that is, so let's say market, tanks today. People on CNBC, they're gonna come and say it tanked because, market thinks Biden's gonna win, Trump's gonna win, whatever, right? And the market goes up, they have some other story. So the idea is for us is we don't want to invest based on some narratives, right? Some story, something that you hear about. So I talked about the process, but I didn't go more into what the process is, right? So our process that we follow has really 3 main factors, right? So one is, what cycle economy we are in a very high level. So we believe right now we're in a high inflation environment, but the economy is not growing as fast. Going through year end and Q1 of next year, the economy might pick up. That's important because if you go back test returns for last 30, 40 years, some asset classes do better depending on inflation and real growth versus other asset classes. For example, technology, when inflation goes up, does really well. That's why it's outperforming. It's not just coincidence. Every time in history that you have high inflation, high growth companies do better than your value stocks, right? But when you have actual economy growing, then those value stocks that people are just losing money on it's going to start performing. So that's the main one stuff that we looked at. The second one is volatility. What do I mean by volatility is you look at the implied volatility in the market, meaning in the options market, right? What is the market is pricing as volatility? How much we're going to have coming forward, and what is actual volatility that's happening? So going through your election question, right? So what we are seeing right now is the market is pricing really high volatility, right? You have this option premiums of basically meaning market is pricing this high event of something going wrong, right? So what would you do? Would you buy that? What is your what is your view? Where you have your asymmetry of your return at this point is on the high side, as the upside, right? So, and you have to look at it. And the last part of it that goes into volatility is volume. So what does that mean is on the up days, is volume going up or is coming down? On the down days, volume of the market is coming down or going up. So when the market, you're in a bull market, right? You have volatility coming down and you have volume picking up, right? So when you have an asset class, you have a particular stock, equity, that the volume goes up, meaning a lot of people buying it, when volatility, meaning the risk of it, how much it moves one day or another, is coming down, that's the asset you want to own. And that's kind of like thinking when you're really managing millions and billions, you want to own an asset class that has a lower volatility, because that shows you it's going to keep going up. The stuff that goes up, down, right, and you have high volatility, and the volume goes up and comes down, that's not a good sign. And I think I want to distinguish it because one of the very main factors that differentiate us versus a lot of firms, we are proud because we don't have big drawdowns. Why? Because when we see volatility of a particular asset class spiking, we bring our exposure to the asset class lower, no matter if it goes higher from that point or lower, but at least 80% of times that would save us from big drawdowns. And that's exactly what happened in February, March, right? When COVID-19 hit, the volatility was already picking up, like when the COVID cases were coming in Asia. So it wasn't like it came out of nowhere. No, it was there. The volatility sign was saying something is going to happen. We brought down our equity exposure down. We bought gold, treasury. So when it hit, it was great for us. So I think it's important that it wasn't narrative based. It wasn't based on some story. So it doesn't matter who wins the election. It just matters what market signal is telling us, and we make decision based on that.
I love it. I mean, first of all, there's a lot there, and really appreciate the detail, because the truth is there's the approach matters. And I think that one thing that we'll talk more about another time, but the hard thing about picking somebody to manage money, right, whether you have $100 million or you have $100, is it's very difficult for the average person, even the savvy investor, to differentiate the difference between good and great until they're actively participating in that relationship. Mm-hmm. Because the truth is, it's very difficult until you're actively managing their money, and it's the proof's in the pudding, you know? But when people are considering working with you guys, right, there's a two-sided evaluation. It's, do we want to work with you? And it's also, do they want to work with you? It's got to be a relationship that makes sense. I'm curious, what are some things that you're looking for when you are considering working with a potential client? Are there indicators that they're a better fit for your firm, or things that may mesh well with your approach that you typically find in those conversations?
I think the important point for the client, right, and in our business, when you're managing people's money, is you need to have the relationship matters, right? So they need to have trust in you, right, in your ability, because selling services is very different, because they pay you some fee, you perform some services. If they don't like you, they cut it. But when they give you money to manage, right, they have the hard-earned cash. So the way they would think about it, the way they would go through it is different, and money brings different emotions in people when they give it. So it's important for the people that they trust you, right? They trust your firm, right? They know the strategy you're doing. So I think what helps us is, I always tell people, I don't buy, sell anything based on what I feel. Is this process, it works, right? And you're gonna see it works. And I think that matters, and people see it every day, and I think you have to build that relationship. It's not particular thing that we say, oh, we only want this client or that client, nothing like that. I think as long as the people understand, right, markets don't always go down or up or whatever, right? I think that's good enough for us.
It's the ability to have the conversation.
Yes.
I think it's you have to have the relationship matters, right? Yeah. It's a trust thing, but it's also you have to have depth of vision. I kind of use that term a lot, but I think that when you're looking for immediate return, you can generate immediate returns, but the ability to engage in a relationship with the expectation of going on a journey together, as opposed to, here's $100,000, you have 30 days to do something. Yeah, you may drive returns, but the truth is it's forcing you into a position where you're thinking immediately, as opposed to thinking about what's the smart financial strategy in a long-term environment, conditional to the day's events.
Right.
As we're kind of wrapping up, it's crazy to say that we're actually almost at the hour. This flew by. I'd love to kind of debunk a couple things. There's a lot of misconceptions in the money management space because now it's so consumer facing that everybody thinks they can manage money. And those that have accumulated a lot of wealth maybe have worked with a number of people, or candidly, they've worked with one person their entire life and they're just accustomed to certain things. Are there any shifts in the financial advisory space that has caught your attention, or things that you've observed that are good, bad, ugly, general points of evolution that are curious, you're curious about?
And there's a lot, actually. So I think there's a lot of misconceptions going on. I think one of the biggest thing that caught my eyes when I was starting doing this, especially on the advisory side of it, right, on 401k advisory to be particular, was how much people don't know what they're investing in, how much they're paying fees, and how much they're losing returns on investing in funds that are underperforming in the market. They are poorly managed, right? Because people think, yeah, it's 401k, I just put the money and I retire, it comes out. But nobody looks into it. And the fees, the way they put the fee structure, the way they disclose it, is complicated by design. So you get confused when you look at it. And I can tell you, there are thousands of dollars that gets allocated in your 401k plans. So if you go look at your 401k plan, I'm sure if somebody comes and knows what they're looking at, they're gonna tell you you have lost on thousands of dollars every year just because you are paying, you have chosen. So basically you can have allocated exposure to the same like equity fund, but you pay like 0.5% more, but 0.5% more on a 401k plan on $1,000 is a lot of money over like 20, 30 years. And not only the fees, but how it's managed. So if they're underperforming the other funds by like 1% or 2% every year, then suddenly you're like 2 or 3% a year, you're underperforming. And that becomes a lot of money. So that piece I was very interesting, how much people, they don't know what's going on in their 401k plans. The other piece is, and that's very interesting, and that becomes part of the education, is people get sold is this kind of like, you buy stocks, you hold forever. All right, that's what you're sold on, and you don't worry to anything, right? And a lot of money managers now, a lot of like, your big shops, they're aggregators. So the person you talk to, he doesn't manage your money, right? He basically aggregates money from a lot of people and he sends it to, his trading desk somewhere else. And, if you want to talk to a person that actually managing your money, you have to have some threshold to even talk like $1 million in assets for them even to talk to you. Even that, right? I'm not sure they would do it. So that piece of it, that the person, they're just aggregating capital, right? And because the fee structure is fixed based on the asset invested, they have all the incentive to have your money invested all the time. But because of our fee structure, which is not fixed, it's just performance, right? If we outperform particular level, we get paid. If we lose money, we don't get paid at all, right? We don't have incentive to have you invested all the time. And that becomes education. Our clients love it. Because stuff happens. Market goes down. If you don't have enough cash to buy it, right? Then what are you going to do? You're just going to sit until the market comes up, right? How much return we have lost? Like if you had money to buy, double down in March, for example, how much would have been your return? So people don't think of it that way because they go and say, yo, just buy it and sit on it. And people will say, oh yeah, from March bottom to now, the market has come out come up like 60, 70%. But it was, if you listen to advisor, you were invested 100%. So you're like all year, you're probably down a couple of percent, right? So that's the thing to think about. You don't need to be investing in the market all the time. Timing matters. And buy and hold, if you don't do it at the right timing, it doesn't work.
Absolutely. It's an education game. It is a confidence game. You have to be willing to put your emotions aside. There's a lot that we could talk about, and Mehdi, I appreciate you stopping by. Everybody that's been listening, there's a lot we could talk about. I mean, you've worked with governments, government agencies, municipalities, sovereign nation. Like you've done a lot when it comes to retail support, when it comes to investing with retail investors, risk management, we could talk a lot about, which I'd like to earmark that for another conversation. But as we close out and looking at the clock here, Mehdi, where can people find you guys? What's the best place for them to go kind of learn more about R2 and what you guys got going on?
So I think the best place is our website is r2advisorspc.com. We are also on LinkedIn, on Instagram, and they can find all the information they need online. And I would love to talk to them. Yeah.
Beautiful. There's a lot more we're going to talk about at another point, but for now, guys, finance matters, education matters. It's okay to not know things. It's just not okay to not go find the answers. You have an obligation to be curious in a world where you want to be the best, you want to win, and if nothing else, you want to have peace of mind. I think great relationships, saving and investing, those are ways to build an insurance policy against what you want to call bad luck. Having savings is that insurance policy. Having great relationships matters. And if you can have a great relationship with the person that's also managing your money, you're having a good day. But for now, Mehdi Tabdili, co-founder and chief investment officer with R2 Advisors, DC based, but they work with people all over the globe. Appreciate you stopping by. You guys know the deal. My name is Jeremy Francesi. This is First Floor Conversations, where the view at the top is only as good as the foundation which preserves it. Stay tuned for more.
Hey everybody, my name is Jeremy Francesi. I'm the founder and president of Strategic Branding Studios, and I want to say thanks so much for stopping by and tuning into the video. If you enjoyed the content, remember to like, comment, and subscribe so you can stay tuned and stay informed on all new releases. If you're interested in learning about how SBS can help you and your organization take marketing and communications to the next level, visit us at strategicbrandingstudios.com for more.